yours.
Okay, thanks a lot for having me. So let me tell you what we try to do in this paper, and in particular, what we mean by money talking. So basically, what we want to learn in this paper is whether firms learn from the stock price about the preferences of their investors. So basic, and these asking this question, in our opinion, is important because a lot of policymakers think that the market mechanism and market discipline in particular could be used to achieve a more environmentally and socially sustainable economy. Now, in principle, this is possible because we know that investors have preferences about environmental and social policies, and these preferences are reflected in the stock prices. So, for instance, seen stocks have lower valuation and they have to provide higher returns. However, we don't know whether firms adapt their environmental and social policies in order to try to actively decrease their cost of capital and therefore improve the environmental and social sustainability of the economy. This is not obvious even if preferences affect the stock prices. Why? Well, first of all, investors could have limited attention. So even if there is some scandal about the environmental and social policy of a company, the price might quickly revert. And therefore, we might see no real effect, even if prices to some extent reflect investor preferences. So, how do we go in testing these, in testing whether firms indeed learn from the stock price as, for instance, the model of Dow and Gorton or the empirical evidence reviewed in work by Bond, Edmonds, and Goldstein tell us? Well, this is hard in principle because there is a lot of literature that shows an association between institutional ownership or institutional owners that have presumably some specific preferences and the environmental and social policies of the firms. And this association is most often interpreted as investor engagement, the fact that some blockholders push companies to change their environmental and social policies, and is sometimes just positive screening in the portfolio, that is, investors just neglect some company. So, but we want to understand whether firms with investors with some preferences learn from the investor trading and the stock price and change their social policy. So how do we do? Well, our idea here is to try to use a shock to investor discontent and to see whether investors indeed react, whether this reaction is reflected in corporate valuation, and more importantly, whether subsequently firms adjust their environmental and social policies. So what is new in our empirical analysis that allow us to see whether firms indeed learn from the stock price and whether financial markets can push firms to become more environmentally and socially conscious is that we come up with a proxy that allows us to capture this a change in how content investors are about the environmental and social policies of the firm. I will introduce this shock in a moment, but I want to tell you the steps that we do in our empirical analysis. So from the shock to that is basically negative news coverage of affirm environmental and social policies. And we expect that investors that have that we classify as having stronger environmental and social preferences, so pro-social investors should, this content should increase. So then we test whether these investors exit to a larger extent than investors that don't have these pro-social preferences. So this would allow us to confirm that our shock is really capturing some sort of investor discontent. The second step is to evaluate whether the market indeed incorporates that this investor discontent matters for firms' valuation. So whether the stock price reflects investor discontent, and whether the cross-sectional differences are such that a given shock has a stronger effect on firms with more environmentally and socially conscious investors. And then the last step is the most important part of the analysis, is to see whether firms that having more environmental and social socially conscious investors after the shock adjust more their environmental and social policy. So this would be a documentation that a shock to investor discontent has larger effects on the valuations of companies with more pro-social investors, and as a consequence, subsequently, firms change to a larger extent their environmental and social policies to meet the investor preferences. So throughout the analysis, I will control for firm sales, and especially to firm sales in different countries with potentially different environmental and socially conscious customers. So you will see that also sales in different countries with different preferences matter for valuations, but at least it doesn't look like that firms learn as much from sales, from a drop in sales rather than from the trading of the investors. So are there any questions so far?
Yes, Mariassunta, we have one question. So yes, the question please. Is about whether you can clarify whether investors' preferences remain the same, whether there is any shock to like risk aversion or other dimensions of the preferences.
So I won't be so structural, but what I think is the way in which we view this is that some investors have portfolios that reveal strong pro-social preferences. And if there is a shock that is a negative news coverage of a firm, and this shock is going to be an idiosyncratic shock. We have some descriptive evidence in the paper that confirms that this really is an idiosyncratic shock. Okay, so we don't think about preferences changing, but we think about the discontent with the firm changing and firms learning from this discontent. I hope this, yeah. So how do we measure discontent? So, well, we measure discontent using a relatively new data source, RepRisk, that monitors ESG business risk for some larger companies around the world. So RepRisk collects negative news on, collects negative news about the environmental, social, and also governance risk of these firms from blogs, social medias, but also from local newspapers and international newspapers. So these news are then classified and counted as environmental, social, or governance. So this will allow us to concentrate on environmental and social news while controlling for news about the governance. We have also information about the reach, whether the news has been covered on international outlets like Wall Street Journal and Financial Times, or just on local newspapers or social media. And we know the severity of the incident. So these news are classified on topics and issues, but we don't have the actual news coverage. But to show you some example, we have in the appendix of our paper a number of examples about this news. So most of these news are not severe at all. It's not the BP oil spills, but is a negative coverage about the working conditions, about the factory in China, for instance, for the toy company Hasbro, or the fact that some financial intermediary is funding environmentally irresponsible mining, genetically modified foods, and so on. What is interesting is that when we searched for the news behind the news count and the label, we also find that in all these cases, companies have a response that is covered by the media. So these largely motivate our analysis, meaning that whether this intensity of the response is recorded in some tangible changes in environmental and social policies that we can systematically measure. We want to understand whether this depends on cross-sectional differences in the investor base of this company. So rep risk is the news counts that we get from rep risk to measure changes in investor discontent, is basically the more original part of the data that we put together. But of course, we need to measure differences in investor preferences. So how do? We have an international data set, so we use data from FactSet, and then we need to classify investors based on how pro-social their preferences are. So our main classification of the preferences of these institutional investors is based on the average environmental and social scores of these investors' portfolio. Meaning that from FactSet, we observe the total portfolio of these investors. So basically we classify investors based on the weighted average of the environmental and social ratings of the stocks in these investors' portfolios. And by the way, this is what Morningstar does in order to rate mutual funds. So we define an asset manager to be environmentally and socially conscious if this portfolio score is in the top tercile. So those will be our environmentally and socially conscious investors for most of the test. We can also classify investors based on the cultural value of their country of origin. Our results do not change. So, and as I told you before, we also control for firm sales, and in particular the geographic distribution of firm sales around the world. In this case also we want to classify the different countries in which a firm is selling based on how environmentally and social conscious these countries are. So in order to do this, we just use the world value survey and the cultural value in the destination country. And obviously for the sales, we cannot use the ratings of the portfolios as we do for the asset manager. So, and here you see basically our classification of the investors. So at the firm level, we have that on average firms have some 5% of institutional owners that we classify as being environmentally and socially conscious, but there is a large variation between firms. And this is precisely what we will use in the empirical analysis. When we classify investors based on cultural values, from the point of view of the ownership, we see that most of the investors would end up to be from countries that are environmentally and socially conscious. And the reason is that, well, those are the countries with that are richer and have a more developed asset management industry that we see in FactSet. So our the classification based on the portfolio of the institutional owners is our favored classification. So I see that there are more chats, so I don't know whether Nuri wants to give me some other questions.
Yes, Mariassunta, we have a couple of questions right now. So the first question is about like the data set rep risk. The participant basically says that rep risk covers negative news. What about the positive news? Well, true value.
They don't cover them. So is basically what they want to monitor is the existence of some risk, but they do not cover news as the company overhauled the board and now has a more diverse board, or this is not in rep risk.
And we also have a question about the risk here. One participant asks whether it's an ex post or ex ante. Does rep risk evaluate the risk ex post or ex ante?
So this is a good question. Is a bit both, because there is an ex ante risk of of having policies that might not comply with the future regulation. But if you look at the examples that I have here, and I have more in the appendix of the paper, all what you see is that there is something that has come to the attention of the media. So for instance, a PNC Bank that is funding mining that results in the removal of mountaintop, poor working conditions that come to the attention of the media and so on. We observed very little of ex ante risk. So we use the word risk because this is a bit the label that the data provider uses, and a bit also because, and this is a bit also in our test, this could become even worse, but think of it as negative media coverage of the firm environmental and social policy.
Okay, another question is, do you analyze different types of institutional investors like pension funds, insurance companies, etc.?
No, we don't so far. So we classify the investors on the basis of their preferences, but we do not distinguish between investors with different organizational structure. But of course, if there were reasons to expect different results, we would be happy to look more at it.
Another question is about like the contribution of the paper. One participant basically suggests that there are papers showing that investors short sell stocks by reacting to this like ECG or CSR risks. So yeah.
Yeah, so as I said at the beginning, is one thing is the short selling to some extent is an aspect of ownership, okay? And we know that measures of environmental and social policies are correlated with ownership, okay? Now, some people have very detailed data sets and can document engagement, and others interpret their correlation as being engagement or perhaps screening. So what I will try to do here is, of course, I will start documenting this correlation between this content and change in ownership. But that is just the first step of my analysis. What I want to show is evidence that there is market discipline, meaning the financial markets are not a sideshow for environmental and social policies, and companies can learn from the price reaction and improve subsequently their corporate policies. So just a relation between some news and short sales. I don't know this paper, but you know, I believe has been done, doesn't prove that there is market discipline, doesn't inform us on that mechanism.
Okay, thank you, Mariassunta.
So this is, and we classify sales on the basis of culture in the destination country, as I mentioned before. And then we have a number of other data sources. Most, all of what I will show you on the change in environmental and social policy is based on the ESG ratings, and here we use Thomson Reuters Asset 4. But I will show you something about the future environmental and social incidents. That is, if a company experiences less negative news coverage in the future, we expect this company to have improved its environmental and social policies. But that said that, we can look also at other aspects of firm environmental and social policies that are more tangible than the ES ratings that are currently widely debated. So for instance, from Sustainalytics, we obtain information on carbon emissions and employees' controversies. So what I will tell you on ESG ratings is true also for carbon emissions and employee controversies. So the improvement in ES policies that we detect occur also for these more tangible and less debatable changes in ES policies. And then we have several other data sources to measure prices, financials, and we have also some measures of general media coverage that we use to design a placebo that I will introduce later. So characteristic of rep risk and all the ESG ratings that are available is that they actually cover only the largest companies. So coverage of environment in rep risk set a boundary on the companies that enter in our sample. So we have some 10 years of data, 33 countries, and almost 7,000 companies. An interesting fact is that the companies that are covered in rep risk are companies that are pretty good from the point of view of their environmental and social policies. For instance, they have very high ESG ratings in rep risk. And this shouldn't be surprising because media cater to interested readers. And environmental and social issues are highly politically charged. So it's not surprising that the companies that attract investors that are potentially more interested receive more of this negative media coverage that we end up using as a shock. Of course, we will have firm fixed effect. So we will look at changes in this content that occur over time. So let me give, since I will show you how, basically, if I want to show you that financial markets matter. Okay, and in order to do this, I need to document several steps. Okay. So first of all, I am introducing a new proxy of investor discontent. So I have to show that this proxy actually matters for investors. So I will start showing that when there is a negative realization of ES risk, there is a drop in ownership by ES conscious institutional investors. And their drop in ownership is actually larger than the drop in ownership by other investors that don't care about environmental and social policies. And so these allow us to focus on the role of the preferences while controlling for a firm fundamental. Yes, and this is particularly important because we also see a drop in sales to countries that we classify as having strong environmental and social preferences. Also, what we show is that when these news are revealed, is the market anticipate that investors and sales reaction will be worse for companies that cater to pro-social investors and sell in environmentally and socially conscious countries, because these firms experience more negative price reaction. So it becomes important to understand whether firms learn from this more negative price reaction. And what we find is that precisely these firms that have more environmentally and socially conscious investors and that experience more negative price reaction improve their environmentally and social policies after a negative realization of the ES risk. And that the effect is concentrated among firms with more informative stock prices. So this basically suggests that there are these sales by the investors, and firms that have an informative stock price react to this price change and improve their environmental and social policies. So basically this would suggest that the market discipline works. Put differently, through their exit decision, shareholders can transmit their preferences on ES policy to companies. And I just want to highlight that here is actual exit that matter, because we have to see an effect on the stock price. It's not the threat of exit that has been highlighted in other corporate governance papers. So there is a question that I can take?
Yes, Mariassunta. The first question is about the preference, or is about wealth, because like the participants suggest looking at whether investors from countries most at risk from climate change are the most active ones. Maybe they're just balancing wealth shocks, because like these activities may be harming their investments or maybe harming their wealth?
So I think that I can answer in two ways. So we are not really capturing climate risk here. It's not a hurricane that is alerting investors about an enhanced risk, and these investors want to rebalance their portfolio. So when I didn't have it on the slides, but when we wanted to try to understand what this negative news coverage was, we wanted to understand whether this was basically capturing country shocks, industry shocks, or a combination of the two. So even so, interaction of country, industry, and time fixed effect capture less than 10% of the variation in coverage of the sample firms. So this is largely very idiosyncratic. So it's unlikely to have an effect on investors. That is the investors that, at least when we use cultural values, we classify as having stronger environmental and social preferences, are mostly investors from rich countries. Is the countries that are more exposed to climate risk are mostly emerging economies in the south of the world. So these also would suggest that is not this kind of rebalancing that is going on. Another piece of information is that domestic and foreign investors seem to react in the same way. And if it was rebalancing, I would think that domestic investors would be more exposed. So.
Okay, another question is, some news of a firm may be financially material to investors, while other news may not be financially material to investors. Wondered maybe whether it may be interesting to distinguish news into financial material and financial immaterial, according to SASP. That was a question.
So I think that this is easier done in theory than in practice, in the sense that indeed we have all the labels about the possible about the topic of the news, but it's very hard to say whether this might be financially material or immaterial. It is, of course, important to control for fundamentals, okay? So, because meaning that we want to make sure that we are capturing something that when we look at changes in ownership, that is related to environmental and social preferences and not to expectation about the future performance. So how do we do this? And this is precisely what I was going to talk about. So first of all, we have evidence that is highly suggestive, but is not a statistical demonstration, meaning that we look at how ownership by investors with sustainable portfolio changes after the news, and then this is in our panel of firms. And then we compare the results with what happens to ownership by investors that we classify as not being pro-social, okay, that do not care about environmental and social preferences. And what you see here is that, so this is the less rigorous test, okay? So, and what you see here is that the ownership by the pro-social investors decreases and is at over 20% drop in their ownership, while ownership by investors that do not care about the environmental and social issues actually increases, okay? So this would suggest that is not only fundamentals that this companies are perceived to be overpriced, because a different type of smart money behave differently. And this is true when we use both a classification of investors' preferences. I don't have a slides with the actual table, but we perform another test that you see that we discuss here in this blue box. So basically, so far, I've been working with a firm panel, okay? But of course, I have data about this institutional stock holdings, the firm, and the quarter. So what I do is that in this much larger data set, in which the unit of observation is the stock holding of asset manager I in firm F during quarter T, I can compare how different institutions are changing their holdings. And I can absorb a firm shock, including interaction of firm at quarter fixed effects. So in such a test, I am just capturing differential tradings, and I can associate it to the preferences of the investors. And I can absorb anything that is happening within the company, that is changes in sales, future financing, performance, whatever, okay? And within these larger data set, I continue to find that investors that I classify as being having pro-social preferences decrease their holdings in companies that have negative news coverage by rep risk to a larger extent than other investors. So even if some of these companies are going to be not to perform better in the future, within the company, preferences appear to matter. Okay, so and so this is from the point of view of trying to disentangle preferences and fundamentals. We also do another very simple test. That is, we look at whether the institutional owners that we classify as being pro-social always sell after negative news. And we use a general negative news coverage that is not related to environmental and social issues from Ravenpack. What you see here is that the behavior is very different. Actually, the pro-social guys, when there is a negative news coverage about other aspects of the company, increase their shareholdings. Probably the companies become undervalued, and that is a good investment opportunity. So there is a very different behavior in this respect. So from the point of view of the change in sales, we find a similar effect when we look at customers. And again, this makes very relevant to try to tease out the fundamental, because there are indeed changes in performance. So we say, okay, there is this trading. So what is the effect on the company's valuation? So we perform basically an event study. So these news are relevant. So meaning that when there is a negative news coverage in rep risk, in the companies experience negative abnormal returns. What is more interesting from our point of view is that the cross-sectional differences between companies are consistent with investor preferences affecting the stock price reaction. So basically, following this negative news coverage, companies that have a higher proportion of owners that are pro-social experience more negative abnormal returns. And of course, this is the returns are even lower if we consider news that are particularly severe or that had high reach. So there is trading following this content, and this trading has an effect on the stock price. So there is a potential for companies to learn from the stock price. So what happens to corporate policies? So before getting there, I want to highlight that these price changes are largely short-term, meaning that if we look at the long-term performance of companies with negative news coverage over the following year, we don't find much effect. So let's look at changes in corporate policies, and I will perform two types of tests. What you have in this table is basically a reduced form. Basically, what I've shown you so far is that the trading reaction of the investors and the price reaction is larger in companies that have negative news coverage, that is where this content increase and where more investors care about environmental and social issues. So what we ask controlling for firm fixed effect and a lot of other characteristics, including the reaction of the sales, is whether these firms improve their environmental and social policies to a larger extent. So here I am using as a proxy for the firm environmental and social policy the ESG ratings from Thomson Reuters. What you see is that following this content, the companies that improve their rating to a larger extent are the companies that have higher ownership ex ante from from investors with strong ENS preferences. So I see that there is a question, so perhaps Dori.
Yes, Maria.
Yeah.
The question is, can it be possible that maybe these environmentally conscious institutions have insider information that they dump before the news and subsequently buy them back to earn profits, to make profits? So not out of non-pecuniary benefits, but like because they have insider information.
So I think it would be a bit peculiar that they have inside information only about environmental and social policies and not about other negative news coverage of the firm, especially because some of the other negative news coverage of the firm that we use as particularly negative sentiment. So I think it would be a bit odd. But what we find in the data is, I didn't show you, but is in the test I showed you, I use negative environmental and social coverage during a quarter, and I look at the contemporaneous changes in ownership. But if I look at changes in ownership 1 quarter ahead, there are further dropped in ownership by institutions that are environmentally and socially conscious. So this would suggest that these investors are not quick in buying back. Is rather what I would think is that the price reversal may also be justified by the fact that then the market learns that the company are improving their environmental and social policies, so things go back to normal. So but
Okay.
we have no evidence of insider trading. So I can show this using the reduced form, but I can also look at, I can also look at two-stage least square, and something happened to my slides when I was doing the last minute changes. So what do? I build on the reduced form. So basically I can use the ex-ante institutional ownership and the news coverage as a way to predict actual changes in ownership by these environmentally and socially conscious investors during 1 year. And then I can estimate how the company policy change due to this change in ownership that is due to investor discontent. And I find the results that are fully consistent with what I've shown you here. So then I go on and try to test the mechanism. And here I should be able to show you both the two-stage least square and the reduced form. Yes. So what we do here is that we borrow a test from Chen, Goldstein, and Zhang that basically want to test whether firms learn from the stock price for their investment decisions. So, and their argument is that if firms are really learning from the stock price, we should find a stronger effect for firms that have a more informative stock price. So a measure of price informativeness is basically how idiosyncratic changes in the stock price of a company are. So we borrow this measure of price informativeness, and then we split the sample between firms that have stock price informativeness in below a threshold and above a threshold. So I think it's bottom tercile and top tercile. And what you see here is that our results, both in the reduced form and in the next slides in the two-stage least square, are driven by firms that have a more informative stock price, meaning that these are the firms that can learn from the market reaction because they know that the stock price reflects information that pertains to the firm and not market-wide shocks. So here you can see the effect in the reduced form, and here you can see the sample split in the two-stage least square. And I'm showing you also the other measure of improvement in environmental and social policies. So what you see is that, so this is the instrumented change in institutional ownership. And what you see is that following this change in institutional ownership due to negative news coverage, these firms that we classify as having a high level of price informativeness are precisely the one that improve their environmental and social policies to a larger extent. So, following a drop in institutional ownership by investors who care. So, as I mentioned before, these results are robust when we use different proxies for for the firm environmental and social policy. So we can look at carbon emissions, we can look at employee controversies and incidents. And is there a question?
I think it's about like reputation, brand reputation. The question is, do firms with such reputation concerns worry more about these risks than firms whose sales depend less on such reputation effects?
So I think that to some extent this is this is very similar to what I'm saying, right? That is the reputational concerns of a company depend on how on the investor base of the company, okay, and we know why, because firms that have different investor base following one of these incidents have a different price reaction. And precisely the firms that should have a stronger environmental concerns are the ones that react by improving their environmental and social policies. So I think it's just a bit different labeling. So
thank you.
So besides testing our mechanism that is based on learning from the stock price and price informativeness, we also look at an alternative mechanism that is the one that has been explored in most of the literature, that is blockholders engagement. So in principle, it could be that the firms that have more of these environmentally and socially conscious investors, some of which sell, have also blockholders that become engaged and push the company to improve following these incidents. So how do we test that? So first of all, we check how relatively large blockholders that we define as investors that have 5% of the company's stock react to this news. So if these relatively large blockholders engage with the company after the incident, we should see that they stay put. While even if we focus on pro-social investors that own large blocks, we continue to see that this negative news coverage is related to sales. Okay, and then we look at basically our reduced form, but we enlarge our reduced form. And then basically we try to see whether the improvement in environmental and social policy at the firm level is related to pro-social investors that have a large block or a small blocks. Okay, so we run this sort of horse race. And what you see here is that investors with small blocks seem to matter to a larger extent than large investors. So here you see that these larger investors trading is not what affects subsequent corporate policies. Okay, so so we conclude that the effect really seem to be the trading and seem to be mediated by the stock price reaction, and that the price informativeness is important. So let me sum up. So what we show is that investor divestitures seem to affect firms' environmental and social policies. The market anticipates that firms with more environmentally and socially conscious investors will be more affected by negative news coverage of their environmental and social policies. And what we observe is that these companies, however, learn from the reaction of their investors and from the stock price, and improve subsequently their environmental and social policies. So we suggest that market mechanism, market discipline can play a powerful role in order to have a more sustainable economy. But this would also tell us that investors must be able to observe what is going on within the firm. So it would be very important for a market mechanism to be fully operational to increase firm transparency. So thank